Hi guys, welcome back to the channel. My name is Dave, and today I want to take a look at DGRO, which sounds like a supplement that I might get from the For Him's website for a friend. But in reality, this is about growing dividends. It's about dividend growth. So today I want to compare and contrast this with a similar product. We're going to have DGRO from iShares versus SCHD from Schwab. It's well-known, well-beloved ETF versus that supplement. Well, actually, let's scratch that. Those two, compare and contrast, like 8th grade English. We'll see which one belongs in my portfolio. If that is what you're looking for, please stick around. Whoop. So DGRO is an ETF, and if you're brand new to investing, that just means exchange traded fund, which is a basket of financial assets. In most cases, that's just straight stocks. And with DGRO, that is the case. They just buy stocks, they put them together, they have a selection criteria. So let's take a look and see if we can understand a little bit about how they pick their stocks for this ETF. DGRO, which is the iShares Core Dividend Growth ETF, it's an inexpensive ETF with an expense ratio down here right at 0.08%. And that simply means for every $10,000 that you or I invest, we're going to pay $8 annually to manage this ETF. So that's quite reasonable. Now, it offers the buyer broad exposure to companies that show a history of dividend growth, and they do that with the following selection criteria. They screen for 5 years of uninterrupted annual dividend growth. They look for paid out dividends that don't exceed 75% of earnings, and they look for dividend yields that are not in the top 10% of the investment universe. Think about that. So we're trying to reduce our exposure to companies with unsustainably high dividend yields. That does occur. When it starts creeping up there, that's usually a good indicator that something is not right. So for those that are familiar with SCHD, this might sound familiar. It sounds like SCHD in many ways, which focuses on an index based on the quality and sustainability of dividends, and it uses a strategy that looks at things like cash flow to debt, return on equity, dividend yield, and 5-year dividend growth rate. So two similar products in many ways, but the constituents, what makes this up, are quite different once we start looking at the holdings of these two. For example, DGRO includes Apple and Microsoft, which a lot of people don't think of as dividend growth stocks, but Apple has sustainably increased its dividend for the past 5 years, so it qualifies. It still only yields 0.5%, but it is growing. So now for me personally, Apple and Microsoft are two of my top 3 individual stock holdings, so I don't necessarily want more exposure to those two. So it's not something that I would necessarily say I've got to have in an ETF right now that I'm buying. Now, as far as yield, both of these pay out quarterly qualified dividends, so they are tax-efficient dividends. For someone in retirement, that can be very important. DGRO is currently yielding 2.41%, while SCHD is yielding 3.56%. That means you're going to get 48% more from the dividend by owning SCHD, which that's a significant difference for those wanting that yield or needing that yield in retirement. But if you look at the top holdings for these two side by side with DGRO over here on the left, we're going to see stocks like JP Morgan, Apple, Microsoft, Johnson & Johnson, ExxonMobil, AbbVie, Chevron, Procter & Gamble, all there at the top. And altogether, DGRO holds 422 stocks, which is a significant increase over the 104 you're going to see here in SCHD. Now, we don't need this many stocks to be diverse, so that's not a factor for me. For the purpose of a retiree, SCHD is sufficiently diversified still. So I'm more interested in what is in here. If we start to look at SCHD holdings, you're going to see some common overlap, but not as much as I expected. Only 46% of these 104 in SCHD holdings are actually in DGRO. Now, top holdings for SCHD are Broadcom, AbbVie, the Home Depot, UPS, Pepsi, Cisco, Amgen, and Coke. So just to pick on one as a comparison and to give some perspective on who might benefit from choosing DGRO over SCHD, with DGRO, right, we're going to have that Apple exposure at 3% of the fund, as we showed earlier, with its pathetic 0.5% dividend versus like SCHD, where you have mighty Verizon stock yielding a massive 7.82%, really propping up that yield. However, it should be pointed out, right, that VZ stock, Verizon stock, as you may know, has really underperformed So it has only hurt SCHD. It's currently down about 17% on the year versus Apple, which has done really well this year, up about 43%. So vastly different. So it does ask the question, how much is this yield costing us? So now we're going to take a look at DGRO over here on Seeking Alpha. I am a Seeking Alpha affiliate, by the way. If you like what you see, there are links down in the description. If it will benefit you, they are offering a $50 discount starting August 30th if you've been looking for a little bit of a discount on this product. But again, a tool that I like to use. So you can see the information that we talked about. You can see the 1-year performance. You can see over here the expense ratio that we talked about of 0.08% in comparison to SCHD, which is 0.06%. Nominally better with SCHD, but not much of a difference at all. But a couple of things worth pointing out as we scroll down here. Let's look at returns altogether here. So price return, S&P, and total return. So total return is going to factor in all those dividends that we're going to be getting. And because they are larger with dividend growth, DGRO, versus the S&P, we're going to see that it starts to improve here versus price return versus total return. So 1 year, it's lagging the S&P. 3 years, it's beating the S&P when we look at total return. And same thing with 5 years. So looks like a pretty good product versus the S&P, like it's holding up pretty well. So if it fits what you're looking for, it might be a good option for you. And down here, if we look at dividend growth, you can really kind of see that strategy in action because it's being applied, right? So back in 2014, 26 cents, 65 cents, 66, and as we move all the way up to 2022, all the way up to $1.17. So you can see if you've been an investor for several years how that's paid off for you in this fund. So now let's look at some historical charts for DGRO. And we're going to start with the 1-year chart, looking at the total return of 3 different products here. So we have DGRO in orange, we've got SCHD in blue, and we got SPYI here in, we're going to call it purple. Now the last year, we've seen a nice rally here in 2023, right? All those tech stocks dragging the market higher. There's 7 or 8 that have really outperformed. Those are all in SPYI, and that's probably one of the reasons we're seeing that 6.59%. But I'd also like to point out, again, if you're in retirement and you want that smoother ride, you've got SPYI here, which is not a volatile product compared to a lot, but out of these 3, it is the most. You can see the lower lows. You can see the higher highs, right? Because it does include all those tech stocks that have done really well this year. And you compare that to SCHD, which has all that value in it and has not performed this year. That really hasn't participated in this market, especially in 2023. Then you got this hybrid model, DGRO, which does include Microsoft and Apple. So what is best for you? You've got a little bit of different options here, but you can see over the last year, you would have been best sitting in SPYI, just buying the S&P 500 over the last year. Now, if we zoom out to 3 years, we're going to see, looks like SCHD really kind of pulls ahead. Again, we're factoring all those dividends back in. So if you're taking those off, you'd have to take a little bit of a different look at this, but it's at 41.84% when you add all those dividends back in over the last 3 years. DGRO is in second place here. Again, hybrid model at 34.5%, and then you got SPYI in last place, but still doing all right. And then we can go out to 5 years, and it starts to get kind of muddled here at this point, right? But you actually do have SPYI pulling ahead, SCHD, and then DGRO. So again, it's going to have different times, different markets. If you zoom all the way out to 10 years, which DGRO does not go all the way back 10 years, so not quite fair comparison. But again, you're going to see SPYI, SCHD, and DGRO and the performance over about a 10-year period. So which is best for your portfolio? So after looking at DGRO, it is certainly a high-quality ETF that's going to be right for a lot of individuals, but it's not for me. I think SCHD still fits better for what I'm trying to accomplish. My largest holdings are still Apple, Microsoft, Google, and then I've got all these different value plays and things like that, and SCHD is kind of where I'm stuffing some of that money right now. So I'm going to still ride with SCHD, but I certainly couldn't fault any money for being in DGRO. It's another good quality product. So let me know which one do you prefer? Or is there another one that I haven't talked about yet? Add that down in the comments and I'll try to talk about it in the future date. If you have any questions on any of these, please ask down below. Really appreciate you watching, like and subscribe, and we'll see you next time. Take care. Whoop.